On January 1st, 2026, the single biggest wealth destruction event in modern history is scheduled to hit the American upper middle class. The government is cutting the estate tax exemption in half. If you are a business owner, a real estate investor, or a professional with a net worth over $7 million, the IRS effectively just put a 40% lien on your life's work. You've heard the saying, shirt sleeves to shirt sleeves in 3 generations. The first generation makes it. The government takes 40% when they die. The second generation spends the rest. The third generation is back to zero. This is the default setting for employees, but not for the Rockefellers, not for the 1%. They use a structure called the Dynasty Trust. It is a legal vault that allows you to freeze your tax liability, rule your money from the grave, and ensure your great-grandchildren are born financially free. Today, we are deconstructing the blueprint to beat the sunset. Welcome back to Wealth Architect. I'm Ben. Let's talk about the concept of fiscal immortality. Most people plan for their retirement. That is 20 years. The 1% plan for their legacy. That is 100 years. The problem is the rule of entropy. In finance, entropy comes from 3 places. Taxes, the 40% death tax every time money passes from father to son. Creditors, lawsuits, divorce, and creditors attacking your heirs. Human behavior. Your own children lacking the discipline to manage the capital. The Dynasty Trust is the only vehicle designed to stop all 3. It separates ownership, which is risky, from benefit, which is desirable. Today, we are going to look at the plumbing of dynastic wealth. We will talk about GST exemptions, decanting powers, and why the state you live in might be the worst place to build your trust. Let's get to the blueprint. First, the math. Right now, you can pass about $13.6 million, single, or $27 million, married, to your kids, tax-free. But the current law sunsets in 2026. That number gets cut roughly in half. If you have $20 million and you die in 2027 without a plan, the first tilde, $14 million might be taxed at 0%. The remaining $6 million is taxed at 40%. Your family writes a check to the IRS for $2.4 million within 9 months of your funeral. If that money is tied up in a business or real estate, your kids have to sell the legacy just to pay the tax bill. The Dynasty Trust allows you to lock in the current high limits today before they expire. You freeze the value outside of your estate. Here's the secret your local lawyer won't tell you. You probably shouldn't build this trust in your home state. Most states have an ancient law called the rule against perpetuities. It says a trust must die roughly 90 years after you do. It forces the money to be paid out to the grandkids, where it gets taxed and spent. The architect builds in dynasty states like South Dakota, Nevada, or Delaware. These states abolish that rule. A South Dakota dynasty trust can last forever. Your money can grow, tax-free, protected from lawsuits, for 300 years. It becomes a family bank that never closes. Do not build a skyscraper on a foundation that expires. Now for the deep dive. The IRS hates dynasties, so they created the Generation Skipping Transfer, GST, tax. They said, if you leave money directly to your grandkids, skipping your kids, we will tax you double. They apply the 40% estate tax and a 40% GST tax. It's confiscation. The blueprint. When we fund the Dynasty Trust, we allocate your GST exemption to it. This puts a golden shield around those assets. It means the IRS can never tax that specific bucket of money again, no matter how many generations it skips. If you put $10 million in today and allocate the exemption, and that money grows to $1 billion in 50 years, The IRS gets $0 of that $1 billion. The exemption covers the growth forever. This is the compounding engine of the elite. Money ruins people who didn't earn it. We know this. So, we add a spendthrift clause. Your son does not own the $10 million. He is a beneficiary. If he gets divorced, the ex-spouse cannot claim half the trust. The trust is not his property. If he gets sued, the creditor cannot seize the trust assets. It is phantom wealth. He lives in the trust's house, drives the trust's car, and spends the trust's income, but on paper, he is broke. You cannot take what he does not have. Finally, how do we prevent them from becoming lazy trust fund babies? We write incentive provisions into the trust deed. Instead of giving them a blank check, the trustee is instructed to match income. For every $1 you earn on your W-2, the trust pays you $1. Encourage work. Entrepreneurship. The trust will fund 100% of any startup business, pending approval of a business plan by the investment committee. HABs. The trustee always pays for health, education, maintenance, and support. You are not giving them a hammock. You are giving them a launch pad. You are funding their ambition, not their idleness. You have a choice. You can let the government be the primary beneficiary of your life's work, or you can choose your family. The Dynasty Trust is the fortress. The GST exemption is the shield. The incentives are the guidance system. If you want to see the breakdown of South Dakota versus Nevada for trust-situs, subscribe to Wealth Architect. We are building a community of founders, not employees. Join me and let's start designing